everyone, welcome to SFC Market Exclusive. As we move into the second half of 2024, financial markets are closely looking for clues on when the Fed might start cutting rates. Adding to the economic uncertainties is the upcoming US presidential election, which could bring significant changes to fiscal and regulatory policies. What's the broader economic outlook for the United States for the rest of the year? What challenges and opportunities lie ahead for the financial markets? To discuss these questions, we are delighted to have Matthew Raskin, U.S. Head of Rate Research at Deutsche Bank, with us today. Matthew formerly served as an economist and policy advisor at the New York Fed. So Matthew, welcome. We learned that you have spent considerable time at the Fed. Could you briefly share your experience?
Sure, and thanks so much for having me. So I joined Deutsche Bank as the head of U.S. interest rate research 2 years ago. And prior to that, I'd spent 15 years working at the Federal Reserve, and in particular working at the New York Fed and in the markets group of the New York Fed, which is responsible for operations to implement monetary policy, so quantitative easing, repo operations, and similar transactions in the open market. And then by virtue of the relationships and expertise that come with that operational responsibility, the markets group of the New York Fed is also tasked with monitoring and analyzing global financial markets in order to inform the Fed's monetary policy and financial stability policies. It was an exceptionally interesting 15 years there. So I joined right as the global financial crisis was getting underway, and so was therefore in a part of the Fed's response to the global financial crisis. I was there during the subsequent period when the Fed was, for the first time, normalizing policy and raising interest rates with a very large balance sheet that had resulted from the QE that was done during the global financial crisis. I was there for the first round of balance sheet reduction or quantitative tightening in 2017, 2019. And then I was there during COVID, and so a part of the Fed's response to the pandemic. During all of that time, I was in analytical management roles. And then during my last couple of years there, I was the advisor to the SOMA manager. So that's the person that's responsible for managing the Fed's portfolio. And in that role, spent much of my time briefing the committee on financial market developments, market expectations for Fed policy, and open market operations.
Can't wait to discuss the Fed with you. But first, now we are midway through 2024. How do you see the U.S. economy? Has it achieved a soft landing?
So I think the economy is in very good shape, but it's probably premature to say that it has achieved a soft landing. I think the landing part of that is about getting inflation back to the Fed's 2% objective. And the soft part is about accomplishing that without a recession or a material increase in unemployment. The Fed has made tremendous progress. The economy has made tremendous progress on bringing inflation down. And it's now quite close to the Fed's 2% objective, but it's not quite there. I think the Fed does still have more work to do to bring inflation down. So in that sense, I think it's premature to say that the U.S. economy has achieved a soft landing. At the same time, the labor market has stayed quite strong. The unemployment rate at 4% is still near historically low levels. And so the Fed has been able to accomplish this big decline in inflation with a still strong labor market and without a significant increase in unemployment. So that's great. But we still face a lot of uncertainties. And as I said, there's still more work for the Fed to do on inflation. So I'm optimistic about the likelihood that the Fed will achieve that soft landing. But again, I think it's a little bit too early to declare victory as yet.
So is there a risk of inflation rising again?
I think there's always a risk around inflation. There's certainly the risk that inflation could reaccelerate from current levels. It is not our baseline expectation. At Deutsche Bank, we have inflation continuing to moderate and gradually moving down towards the Fed's 2% objective. But there's certainly a risk that things don't unfold in that way. The Fed has benefited from some very important supply side tailwinds over the past couple of years. So we had a healing in global supply chains that brought goods inflation down. So core goods inflation is actually running at a negative level here in the US. And we also benefited enormously from an expansion in labor force, both through increasing labor force participation and a sharp rise in immigration. So the Fed has very much benefited from those supply side tailwinds over the past couple of years, and that has helped them to bring inflation down. I guess I worry less about a reacceleration in inflation, a prospect that it could rise materially from current levels, though that is again possible. There's always the prospect of shocks out there. But I worry more about the possibility that inflation could stall out, could level out around current levels, which is uncomfortably high for the Fed. So I think that's probably the bigger risk at this point, that inflation progress stalls out at a level that is uncomfortably high, uncomfortably far from the Fed's 2% objective, rather than a meaningful reacceleration in inflation.
As we head into the second half of the year, what are the main challenges and opportunities for the U.S. economy? Do we need to worry about the U.S. election?
Yes, I think the second half of this year, we're coming into just an exceptionally interesting and challenging environment for the U.S. economy and for the Fed. I guess I'd separate that into two pieces, clearly related, but in my view, separable. On the one hand, there's the economic outlook, and we just talked about the prospects that the Fed will achieve the soft landing, or alternatively risks that inflation could reaccelerate. And I think we're going to learn a lot about where we are on that in the coming months. We have a first Fed rate cut coming towards the end of this year. The market is pricing something a little bit sooner than that. And I think that is very much going to depend on how inflation unfolds in the coming months and whether the labor market stays resilient. So I do think there's a lot of uncertainty and a lot of challenges associated with the macro economy. At the same time, as you noted, we have a presidential election just 4 months out from here. And that introduces a lot of uncertainty about policy and about policy makers. And so we're very focused on the prospect that the election could result in meaningful changes in U.S. fiscal policy, although it looks like either of the candidates is probably likely to continue to run significant budget deficits, something probably above 5.5% or 6% of GDP, though the composition of those deficits, I think, could look quite different depending on the outcome of the election. There's also the prospect that we could get significant changes in trade policy, in immigration policy, and in regulatory policy, all of which have the prospect to have a big impact on the economy, and so I think present some big challenges and opportunities for the economy and for investors over the second half of this year.
Many central banks are starting to cut interest rates, such as ECB and Bank of Canada. What does this mean for the global economy?
So I think the Bank of Canada, the ECB are responding to data and to the outlook in their jurisdictions. But I think the fact that both cut interest rates is sort of symbolic of the fact that globally central banks are moving towards easing policy. That should mean that all else equal, there's a bit more support for demand, there's a bit more support for growth, and that should generally benefit the global economy. We are in an interesting environment where, despite some fairly notable divergences in the economic outlooks across advanced economies, the market is pricing quite similar synchronized policy cycles. So if you look at the total amount of cuts that are priced in for the ECB, for the Fed, for other major advanced economies, there's a remarkable degree of synchronicity in those. So again, I think as we move into a world where global central banks are beginning to dial back policy restraint through cutting interest rates, that should ultimately support growth in the global economy.
What impact will this have on the Fed's policy?
Yeah, so I mean, clearly there are global spillovers, but I don't see the impact of those central bank interest rate cuts as having a really big effect on the Fed. I mean, to the extent that it strengthens global demand, as I mentioned, that should help to support net exports in the U.S. I think there are also clearly some important financial market linkages. So to the extent that you get more interest rate cuts from foreign central banks, that should tend to reduce longer term interest rates globally and spill over and put a little bit of downward pressure on US interest rates. It also potentially has impacts on the exchange value of the dollar. And those are financial conditions that for the Fed matter. But I don't think those are first order for the Fed. I think for the Fed, it's really about what impact might those have on the outlook for inflation domestically, on the outlook for the domestic labor market. And I actually think the linkages, the spillovers are much more pronounced going from the Fed to those other central banks than the reverse. I mean, and I think you see clear evidence of that empirically. So if you look back at how Fed policy announcements have impacted foreign bond yields, you see very strong spillovers that mean that Fed policy not only has a big impact on U.S. interest rates and financial conditions, but also spills over to affect bond yields and financial conditions globally.
Isn't it unusual that the ECB and other central banks are moving faster than the Fed? What factors are holding the Fed back from cutting rates?
Yeah, so I think you're right. It's a little bit unusual for global central banks, particularly in the developed markets, to be moving ahead of the Fed. But arguably, we're talking about a few months, maybe 6 months. So I don't view that difference as too large. And again, if you look at what's priced in over the next couple of years, there's a remarkable degree of similarity across major central banks. I mean, you're right that we came into this year with the market pricing a very aggressive path of Fed cuts, and they've been disappointed. The Fed has proceeded much more cautiously, and I think that really reflects two factors that are the Fed's dual mandate objectives. So inflation or price stability on the one hand, and employment and the labor market on the other. They're very keen to avoid a scenario where they cut rates and then learn after the fact that maybe inflation is a little bit more persistent, a little bit stickier than they expected, and they need to go back and hike again. I think that, in their view, would create a lot of policy uncertainty, a lot of market volatility, and generally be a very counterproductive approach. So on the one hand, inflation still a bit too high for the Fed, who's looking to have more confidence that it's on a sustainable path back to 2% explains why the Fed is proceeding cautiously. And on the other hand, the fact that the labor market has remained strong, the fact that the unemployment rate at 4% has risen and is reflecting a cooling in the labor market, but is it still low levels by historical standards? And we've seen a lot of that adjustment in the labor market come through other dimensions. It's come from an increase in labor supply, as I mentioned earlier, related to increases in labor force participation and immigration. And it's come from a moderation in demand that we see come in things like the number of job vacancies or job openings relative to the number of unemployed people. So I think the fact that the labor market still looks like it's fairly strong means that the Fed can afford to be cautious as they think about moving towards interest rate cuts. So I think it's really those two factors. Inflation still a bit too high, the Fed not yet confident that it's on path to 2%, and a labor market that still looks strong. I think the other element of that is, as I mentioned before, I think the Fed is keen to avoid a scenario where they cut prematurely and find that they need to go back in and hike rates. And that means that although they've been communicating that they view the risks to their two dual mandate objectives, to inflation and the labor market, as moving toward better balance, I still think they see the sort of loss or costs associated with a mistake as kind of asymmetric, and would prefer to ease and cut rates a little bit too late rather than a little bit too early.
What's your prediction?
So we have a first cut coming in the December at the December FOMC meeting. We think inflation is still going to be running a bit high for the Fed at the time of the September FOMC meeting. And then the November meeting, in our view, is a little bit too close to the U.S. election. That meeting comes 2 days after the U.S. election, but the blackout period, which is the period where the Fed can no longer communicate with markets ahead of their meetings, and typically the Fed kind of communicates their policy intentions ahead of that blackout period. That period comes into effect about a week and a half before the election. So if the Fed is cutting because of declining inflation and not because the labor market is weakening to an unexpected degree, we think the November meeting is probably not the time that the Fed will begin. So we have them starting in December. If the inflation data comes in favorably or we see a little bit more weakness in the labor market, I think it's possible that they could go by the September meeting, but it's not our baseline forecast. And then we have them cutting, quite gradually in 2025 and 2026, and back to a level for the Fed funds rate, the longer run Fed funds rate, or so-called neutral nominal rate, that is around 3.75%. So that is well above where the Fed has the longer run rate in their projections, and a little bit above where you see it in market consensus.
What do you think about the Fed slowing down the pace of balancing sheet reduction? What impact will it have?
Yeah, so the Fed at their May meeting, the FOMC announced a reduction in the pace of balance sheet reduction, or quantitative tightening, QT as many refer to it. That reduced pace of QT, I think, was designed to proceed cautiously with balance sheet runoff. I think they've made a lot of progress in reducing the size of the balance sheet over the past 2 years. They have reduced their securities holdings by nearly $2 trillion over that period. But they, before May, were continuing to go at a quite rapid pace, roughly twice the pace of QT as was the case during the prior round of balance sheet runoff in 2017, 2019. And so I think the Fed sensibly decided to slow down the pace at which they're running off the balance sheet. And the goal there is really to give the financial markets and the banking system more time to adjust to the decline in central bank reserves and broader Fed liquidity that results from the Fed's balance sheet reduction. And by giving the market and the banking system more time to adjust to that balance sheet runoff, the Fed views that as sort of reducing the likelihood that something could go wrong and force them to bring QT to a premature end. And so by going a little bit more slowly than they were, they could ultimately reduce the balance sheet by more than they otherwise would. You asked about the impact on financial markets of QT. I think about that in kind of two ways. I think on the one hand, on the asset side of the Fed's balance sheet, as they reduce their securities holdings, that results in more Treasury securities, more agency mortgage-backed securities sitting in private portfolios. And so that means that private investors hold more interest rate risk. And as a result, I think they should command higher risk premia, higher term premia on those securities. And that should boost longer-term interest rates in the U.S. a bit. And it should tighten broader financial conditions somewhat. Now, I think a lot of those effects take place when the Fed announces its plans. And if they then execute on those plans more or less in line with market expectations, I don't expect to see a big adjustment in longer term interest rates or broader financial conditions as the Fed simply delivers on its plans related to balance sheet reduction. On the other hand, I think there's an important second effect, which is related to the liability side of the Fed's balance sheet. So as they reduce their securities holdings, that leads to a reduction in central bank reserves and broader Fed liquidity. And that should result in tighter funding market conditions. It should increase money market spreads in the US and globally in dollar markets a bit. It should result in a bit more volatility in dollar funding markets. But overall, again, I think because the Fed is approaching this in a very cautious way, informed by the experience with balance sheet runoff in 2017, 2019, I don't expect that we're going to see any acute stress in funding markets. I expect us to see a sort of gradual reduction in liquidity that results in, increasing volatility, widening money market spreads, but in a somewhat controlled fashion.
In retrospect, how do you evaluate the Fed's massive quantitative easing during the pandemic? Was it necessary?
So I do think that the Fed's QE during the pandemic was an essential element of the Fed's and the government's response to the pandemic. I think with the benefit of hindsight, that QE program may have gone on a bit longer than necessary. But I think it's helpful to back up and remember what the Fed actually did. So, in February and March of 2020, as it became clear that the global economy was going to shut down as a result of the pandemic, there was a very wide, sort of broad-based rush or dash for dollar cash that meant a lot of investors sold their securities in order to hoard dollar cash. That meant that the functioning of some financial markets deteriorated quite sharply. So the Treasury market didn't function very effectively. We saw risk transfer. We saw price discovery hampered in the Treasury market and in the agency mortgage-backed securities market. And so the Fed stepped in and bought very, very substantial amounts of those securities with the goal of supporting market functioning. And so I think, again, that was a really vital element of their response. It helped to calm financial markets and was really the right thing to do and very important to do. Over time, as financial market functioning improved, the Fed's objectives for their QE evolved and expanded a bit. They expanded the focus to not only include sustaining the improvements in market functioning that they had achieved, but also to ease broader financial conditions with the goal of stimulating demand and stimulating the economy. So that was an objective that was much more like the QE programs that were done in 2009 through 2013. I think there was an understandable goal of supporting the recovery. The Fed's overnight interest rate was pinned at the effective lower bound. They had reduced that rate to a range of 0 to 25 basis points, which is as far as they were willing to take it. And to provide further support to the economy, they used QE. And I think that was the right thing to do. I think what you can debate is whether those purchases perhaps went on a bit too long. But you have to remember that, the Fed in 2021 still thought, as many in the markets did, that the burst of inflation they were seeing was likely to be transitory. They were confronted with a very high unemployment rate and lingering memories of the very sluggish recovery from the global financial crisis. So I think, understandably, we're looking to continue to provide support to the economy and doing that through ongoing asset purchases. So those purchases ran into 2022. I think, again, with the benefit of hindsight and knowing what we do now, the Fed might have judged it appropriate to wind those QE purchases down a few months earlier. That might have meant that they were in a position to begin raising short-term interest rates a bit earlier than they actually did.
It seems like we are all coming to terms with the idea that the Fed will likely keep interest rates high for longer. What does this mean for the equity and treasury market moving forward?
So I think I'll start with the Treasury market. I think to the extent that the Fed does, hold its policy rate higher for longer, and longer maybe than the market is pricing in or than market participants expect, that should tend to push up yields across the curve. So that would result in higher borrowing costs for the U.S. government through the Treasury market, but also for households through higher mortgage rates, higher rates on auto loans and credit card loans. It should also result in higher corporate borrowing costs. I think what that means for broader financial markets, for the equity markets and other risk assets, depends very importantly on why the Fed is holding its policy rate higher for longer. If, on the one hand, inflation continues to gradually come down, but growth stays strong and maybe accelerates, and the labor market stays strong, the Fed may revise their assessment about that neutral level of the policy rate. And that could be an environment where, the beneficial impacts of the better growth outlook mean that the capital markets, equity markets, credit markets actually stay quite resilient, remain strong, despite the fact that the Fed is holding a policy rate higher for longer. And I think that's been more or less what we've seen over the last year or so, where equity markets have been very, very buoyant. Credit spreads have remained at historically low levels, even as the Fed has held its policy rate at a very, very high level. On the other hand, the Fed winds up holding its policy rate higher for longer, longer than the market's pricing, longer than market participants expect, and that's because inflation is staying persistently high, sticky, and maybe even reaccelerating. I think that's an environment where the impact on policy uncertainty, on market volatility, and by extension on capital markets, equity markets, and credit markets could be much, much more adverse. So again, I think it matters a whole lot, on why the Fed is holding their rate higher for longer.
What advice do you have for investors under the current economic situation? Which asset will perform better?
Yeah, so as I mentioned, our forecast has the Fed beginning to very gradually cut rates toward the end of this year, a bit later and a bit more gradual than is currently priced into markets. I think that's going to put a bit of upward pressure on broader interest rates. At the same time, we see other factors, probably most notably, big fiscal budget deficits in the U.S. as tending to put upward pressure on term premia and leading to steeper yield curves, particularly at the back end of the yield curve. So I think that, alongside an election that might well produce even bigger budget deficits and could very likely produce more restrictive trade and immigration policies, would kind of further the increase in term premia and the steepening at the long end of the curve that we expect. So as a general matter, we recommend that clients position to be roughly neutral duration. We haven't talked about it in this discussion, but there are some key downside risks. The labor market could wind up weakening a lot more than the market's expecting. So finally, I'll just say I think the process of winding down the Fed's balance sheet does have important implications, as we discussed, for global dollar funding markets. So we should generally see that tighter liquidity conditions sort of flow through and affect financial markets. Though, as I noted, we don't expect to see material stress related to that.
Thank you, Matthew.
Thank you. I appreciate the opportunity.
As Matthew pointed out, navigating the economic landscape into the second half of 2024 involves balancing optimism with caution. The Fed's decision on potential rate cuts, ongoing inflation worries, and how global economics play out will definitely impact how investors plan ahead. That's all for today's show. Thank you for watching. See you.